Okay, everybody, welcome to this month's Investing in Identity Forum. I am Travis Dre, the founder CEO of Liminal, joined today by Dave Fields, partner at PTB Ventures. Welcome, Dave.
Thank you for having me back. Obviously, we were missing Cameron, but we'll do our best to carry on in his absence.
Yeah, missing Cameron, but not missing Cameron at the same time. He dropped. He's on vacation this week, so
Oh,
he dropped his dog off at noon today.
mm,
But
mm.
we found out that the dog was staying with us
At noon.
yesterday.
Okay.
Yeah.
Almost 24 hours notice.
Yeah. So, but we love Ginger, but I'm sure he'll enjoy his time out in Portland. I think he's going to Portland. Have you been to Portland recently?
I've not been to Portland recently. No, I've been once.
Nice.
Nice
Yeah.
town.
Yeah. Well, how's your summer going?
Good. Good for the most part. A little hot.
Mm-hmm.
But obviously there's been, the market slowed down a bit, so it's been a good time to step back and kind of reassess some things. I know we're going to get to it in a few questions here, but it's interesting, and I look forward about how things are going to shape up over the next 6 to 12 months. Seems like maybe we're starting to get a better idea of what kind of economic scenario we're headed into or where we are in the cycle, but there's still a lot of questions that remain. So we'll see.
Yeah, agreed. And I know we're going to talk about that here in a bit. And also we're going to talk about one of the bigger deals that we've seen so far, at least in the summer months here, kind of late spring into the summer, with human security and PerimeterX. Kind of what does that mean for the market? And then, of course, talking more about general market trends with Dave. So with that, kind of breaking out into this deal with Human and PerimeterX, very surprising deal. So this was announced last week. For those that have not seen this, maybe enjoying some summer a little too much, they announced a merger on Wednesday. Maybe you guys don't know Human Security that well. This is a company really focused on bot detection, bot mitigation, fraud detection, whereas PerimeterX really focus on safeguarding web apps, account takeover, and other automated fraud pieces. But on the surface, these companies are really considered competitive threats to one another. And these two companies are the companies that we point to in the space. We're talking about UEBA, we're talking about fraud detection. These two companies really kind of stand out. But while they are competitors, and we do really like this merger, these two companies are very different from one another and actually support different areas of that bot detection, account abuse, fraud problem. A lot of those questions that I know CISOs and marketers alike are starting to ask. But going forward, this merged company is going to go under Human. So if you're thinking about it, I personally don't care for the name Human Security because Human, it's really hard to find when you're trying to Google it. You guys might actually remember them as White Ops. This is a company that was bought by Goldman Sachs merchant banking group in kind of 2020, 21. And then rebranded to Human and kind of built this thing out. But going forward, both PerimeterX and Human are going to go under Human Security. And this is going to really strengthen a lot of that Human Security's bot detection capabilities alongside PerimeterX's account protection capabilities. So this will be what they're going to call a human defense platform, which I actually really like. Clear synergies between these two companies coming together, offering a comprehensive solution in one platform. You already know what they're going to do. Like this deal a lot. Other things to kind of note about this deal that I think are really interesting. This will be a very large company. They'll have over 500 customers, and they actually announced that they'll have about 100 million in ARR. So it's a good comp set for those that are trying to keep track of this particular market, specifically bot detection, fraud prevention, abuse, right? $100 million ARR looking at it. And also, Tomer, the Human Security CEO, will continue as CEO of this company. And the last thing I'll kind of note about this deal and what I really like about it is the bot problem is extremely interesting. We've talked about this quite a few times this year, right? With Twitter, we've talked about this without Twitter, right? It's not a problem that's going away. It's getting increasingly more difficult alongside other types of spoofing attacks. So we're hearing a lot right now from our clients around both bot detection, bot mitigation, abuse, account abuse, fraud detection, and specifically different types of spoofing mechanisms. And so we expect this to be a big topic for this industry for a very long time to go. So human PerimeterX merging together to create a single human security group. Very interesting. The lot and one other thing that's really interesting here, Dave, and I don't really talk a lot about bot detection, but we do a lot of growth strategy engagements in this space. And what's really fascinating to me is the CMO is actually the one that typically identifies bots versus the CISO.
Yeah.
So it's, because they're trying to do all these marketing strategies and they're not getting the results they expected. And they're the ones that are actually raising the flag. So really, until the CISOs have the tools and capabilities to identify and mitigate bots and other forms of spoofing attacks, there's going to be a massive market here. So, as investors in the space looking at this, look at this as a good proof point in the market, a nice comp set for you as you're evaluating other companies out there, right? I think Datadome as another very similar company to this, right? Go look at those other comp sets, put this one in there, and then, kind of watch this one, see how they perform out in the market over the next 12, 24 months. Really red hot market for this type of capabilities, these types of technologies. You have two companies put together, well capitalized. There's another $100 million in credit going on the balance sheet here. This is a really interesting deal, and one that, again, as strategists, as investors, worth keeping an eye on and worth doing a little bit more digging and research in, so you have that comp set when you're evaluating other similar companies over the next couple of years here.
So, I mean, this isn't, Travis, I do have a question for you. It's not really specific to this deal, but for the last, I guess, since the market, pullback started, really accelerated probably February, March this year, and we saw a cool down in fundraising activity. We've been talking about kind of a pickup in M&A activity and how different investors have been looking at, particularly PE investors, have been looking at kind of the identity space as attractive for roll-up strategies. And so this kind of deal kind of, to me begs the question a little bit of, where do you think we are in the M&A cycle right now? Do you think we're beginning? Do you think this is the peak? Do you think we're getting towards the end of it? Or like where, which inning are we in? And kind of what other sectors do you think we're going to see some deals announced in over the next 6, 12 months?
No, it's a great question. And, in a normal year, so to kind of contextualize things, in a normal year, we expect the first half of the year to be a lot of fundraising, a lot of deals being closed, right? A lot of announcements. That's why it's very exciting, kind of that first quarter. Come July, everybody's in their executive offsites doing their board discussions, thinking about that strategy for the following year, right? So coming out of kind of that early July, mid-July executive offsite decision planning, we start seeing a lot of activity around M&A, large transactions, investments, fundraising, you name it, right? All those plans need to start to get executed during Q3. And of course, in Q4, we're now in like our full diligence cycle for a lot of this stuff, right? What I think is really interesting right now is a lot of those executive offsites and those board discussions happened before July. These happened in May, these happened in early June. And so we're seeing early activity now in the diligence phase starting in July and August. So a little bit earlier than we would typically see, but the questions we're getting asked are way different. They're not about, does this investment make sense? Can this company win on its own? It's questions about, can these two assets pair well together? So to answer your question very directly, we expect to see more consolidation in the market, similar to what we see here with human security and PerimeterX, where you have two very synergistic, competitive assets out in the market vying for very similar customers, right? That can tell a very good story, right? They can combine those customers, offer a single vendor solution at the platform level versus multiple platform solutions solving 2 to 3, 4 different problems at a time. So we expect that to continue to happen. We also expect there to be some fundraising activity. So, I don't expect the private markets to slow down. People got to deploy cash, and companies did not raise enough money for the growth that they projected. So we are starting to hear about private placements and other investments kind of on the horizon. And I guess that actually goes, question to you. So let's actually kick over to a little bit more of a conversation on how the markets are going. Dave, you and I talk a lot about this, and we text back and forth. But markets took a little bit of a different, kind of almost like a rebound in July from our conversation in July. What's happening here?
Yeah, I mean, look, I think there's a couple old sort of like, Wall Street adages to kind of throw out that kind of come to mind. So I guess it start like July was one of the best months for NASDAQ and the S&P 500 on record. The S&P 500, both of them were up close to 10%. S&P 500 just a little less. NASDAQ was up more. And so there's a couple things that kind of like follow from that, right? Which is one, sometimes you get the most vicious or aggressive market rallies actually in the context of broader bear markets. If you look at some of the different stock rally, like there's some of the greatest months on stock market performance on the positive side, they actually happened between 2008 and 2010. And so the reason for that is that sometimes when you have markets are starting to price in very adverse scenarios, you have so much selling that then anything that just sounds less bad is then a catalyst for investors to redeploy into the markets, right? We know that markets are prone to excess on both the upside and the downside. And so one of the things, so the big question for everyone kind of in public markets right now was this a bear market rally or was this a market bottom? Or is the market bottom, is that now kind of behind us? Is that what took place in kind of that May, June timeframe? And now July is the part of a new sort of secular bull run. My view is, I don't know. I think there are some reasons to feel positive about where markets are right now. Some of the inflation data is showing signs of peaking and maybe cooling off a little bit. We continue to have positive job growth. Clearly in the tech sector where we're all focused, we've seen layoffs and rifts, companies reevaluating their hiring plans. I think there's a number of examples from that. I'm sure we're all familiar with them. But outside of tech, the economy and job creation is actually doing all right. So we continue to add jobs every month. So to me, it doesn't seem like we're headed into a real adverse or a recession that looks like 08, 09 or the dot-com bubble. That doesn't seem to be the case, but it's hard to tell exactly where we are. And it's something that we're probably going to need a couple more months of data to really figure out. But going to the next question, which is, do I expect to see a rebound in private markets? I do. I think what happened is that there was so much shock and I think people were so stunned by the pullback in kind of the second quarter this year that there was really a big freeze in sort of in funds investing in deals. And you can see that in the reduction in deal count at any stage you look at. Deal count's down more than 50%, regardless of stage. Now, but one thing that did happen is we did see that funds like Andreessen, Insight Partners, even Tiger Global, they continue to raise these large multi-billion-dollar vehicles. So at some point, just like we saw investors in the public markets redeploying cash in July, we're going to see some of these funds start to more aggressively deploy their cash again as well. So I think we're going to see a major acceleration in, call it like, once we come out of the summer months, we get to the other side of Labor Day. I think we're going to see a big pickup in deal activity and deal count in the end of the the last quarter of the year. What kind of, to me, remains to be seen is kind of what those valuations look like, and where does the market start to normalize. And so that's really the big question for me. I think if you're a top tier company right now, top decile, you have no problem raising. It's just a matter of will you accept the valuation that's on offer right now? And I think as we get later into the year, we'll see companies that I don't want to say are underperformers, but you won't have to be perfect or pristine in your metrics. If you just have, a few things that show great, signs of product market fit, or good unit economics, I think you'll be able to raise even if you're not necessarily in that, proverbial 98th, 99th percentile. So I do expect a pickup. It's just where is the market going to find equilibrium as far as pricing, and that we need deal count, and we just need markets to get to work and transact. So that's kind of how I see things right now. We have a little bit of a slower period now. There's no FOMC, the Federal Open Markets Committee, those meetings have been major catalysts every month now. They take August off, so we won't hear from them again until September. So I do expect August to be a slower, maybe less volatile month than the past few have been. But I do then expect to see a much faster pace of news and market catalysts in September and October.
No, that's super interesting. And to your point about the kind of the big funds, I mean, to your point, they keep raising money. I mean, it's got to be deployed at some point. There's still companies that need a lot of money. I've been hearing a lot about quiet deals. So even kind of convertible notes and other types of things to kind of load up the balance sheets for some of these companies that don't actually have to do a priced round at this point.
Yep.
Do you kind of expect some of the money to be dropped into that, or do you kind of expect it to be back to the races come 6 months from now? Obviously, you're crystal balling this a little bit.
Yeah. I mean, well, look, so a lot of, so there's certainly companies that, have done either flat rounds or, extensions of their prior round to put some cash on the balance sheet, or have explored venture debt. If you're raising with venture debt, which a lot of companies have done, to kind of punt on how do we get cash without pricing the company during a market, period of extreme market turbulence. Even if you're looking at venture debt, typically there are, venture debt, one of the components in it is typically warrants. Warrants are the right to buy new stock directly from the company at a set price. And typically those warrants, the pricing on those warrants will have increasing discounts over time. So companies that have taken on venture debt, even if they put cash on the balance sheet, are still going to have an incentive at some point over the next 3, 6, 12 months to go out and raise capital and repay that debt. Particularly if they're doing well, they're going to want to do that sooner rather than later, so they can limit or some of the dilution from those warrants. So I do think we'll see. So like companies have been exploring all possibilities. We've even seen companies raise. I can't remember, one of the hedge funds, and I'll forget the name right now, actually raised a vehicle specifically to do structured finance deals, which are, rather than buying equity, you're buying some sort of note or debt instrument that has a whole, different repayment and coupon mechanics so that they can get a structured or fixed yield, but in the capital structure, they're above the equity. So we've seen some vehicles like that raise. So we're going to continue to see sort of like hybrid capital deployed, but even that is just delaying. That just delays when you ultimately do go out and price your company and price your equity and price your cap table once more. So that activity doesn't eliminate it; it just sort of defers it. So I think we'll probably see. It may be until the fourth quarter, but we are going to see a pickup in deal activity. I don't think it's going to return to what it looked like a year ago at this time, where, if you recall, we didn't talk about more abstract concepts like where are we in the market cycle and how does M&A look. I mean, these videos were sometimes 45 minutes long, and all we did was discuss deal after deal after deal. It's not going to return to that sort of environment, but it's certainly going to be much faster or much more. There's going to be much more volume than there is right now. I think kind of one of the big differences we'll see, though, is that these big funds that have been raised for the last couple of years, they've been deployed on an almost 18-month life cycle. With like the big fund managers going back out sometimes every year, sometimes every year and a half. And I think we're going to return to a more normalized environment, which is probably more like every 3 years or every 2.5 to 3 years. So if you go from 12 to 18 months to 30 to 36 months, yes, fund size growth will offset some of that, but we're going to see probably normalize around a level that's 35-40% down from where we were in the peak of like COVID, work from home, e-logistics mania, if you will.
Yeah.
So that's kind of like where I see things headed. It's just, do we get there in 3, 6, 12, or 18 months is kind of the thing I think markets are still figuring out. I'm
Yeah.
confident that's where we're going to normalize. It's just, how long does that take?
No, I think it's all very good points here. And I think what we're going to do in August is obviously let people continue to have their vacations. September, come back here very strong, understand what's happening in the market, what type of reactions that we've seen so far, if any of the big deals have started to close. So I think there's a lot more to kind of carry on here, but we're going to come to a conclusion on this episode here. And before we do, want to talk a little bit of our latest research, which is the 5 consumer digital identity conditions. This is for our members only. So if you guys are members and watching this, feel free to log into your portals. You can kind of check that out. What we've done is over the course of 7 years, really pulled together these 5 conditions based off of I would have to say over 100 engagements looking at consumer digital identity. So specifically digital identity products and services for consumers. And we bucketed those conditions down into privacy, commerce, data protection, reputation management, and inclusion. So for members, check that out. It's a nice little tool to have in your cap when you're out there looking at new products. And then lastly, we have our liminal summer networking event at Yankee Stadium on August 17th. So again, this is for our members. So if you guys are around, would love to see you in the Bronx. And with that, I want to thank you, Dave, for joining us on this month's Investing in Identity Forum.
Yeah, thank you.